How banks decide how much house you really qualify for. Banks like to present mortgage approval as a vote of confidence. You apply, they run the numbers, and then they tell you how much house you qualify for. The word qualify sounds reassuring. It sounds like someone has carefully looked at your life and decided what is safe, reasonable, and sustainable for you. But that's not what's happening. What the bank is really deciding is not how much house you can afford to live in comfortably, but how much debt you can carry without immediately breaking their rules. To understand this, you have to separate two ideas that most people assume are the same thing. One is personal affordability, which is about your real life, your stress levels, your future plans, and how much flexibility you want. The other is institutional risk tolerance, which is about probabilities, averages, and how likely you are to keep making payments long enough for the loan to be profitable. Banks only care about the second one, and once you see that clearly, a lot of financial confusion suddenly makes sense. When a bank looks at you, they are not trying to protect your lifestyle, they are trying to protect their balance sheet. They don't sit there wondering whether you'll still enjoy dinners out, family trips, or sleeping well at night. They are asking a narrower question. Based on your income, debts, and credit history, how large a monthly payment can we reasonably expect you to keep making, even if life gets a little uncomfortable? This is why high-income earners often get approved for shockingly large mortgages. On paper, they look resilient. Their income gives the appearance of a cushion. If something goes wrong, the assumption is that they can cut spending elsewhere to keep paying the mortgage. From the bank's perspective, that's a feature, not a bug. The mortgage becomes the top priority bill, the one you sacrifice other parts of your life to keep paying. The first major number banks care about is your gross income, not your take-home pay. This detail alone causes more misunderstanding than almost anything else in personal finance. Gross income ignores taxes, ignores retirement contributions, ignores health insurance, and ignores the fact that not all income is equally stable. But it's convenient, standardized, and easy to plug into formulas, so that's what gets used. From there, banks apply debt-to-income ratios. These ratios sound technical, but the idea is simple. They look at how much of your income is already committed to debt payments, then decide how much more they're willing to add. The key thing most people miss is that these ratios are not designed around comfort, they are designed around survival. As long as the math suggests you can technically keep paying, the loan works from the bank's point of view. Housing expenses are usually allowed to take up a surprisingly large portion of your income. This includes not just the mortgage payment, but also property taxes, insurance, and sometimes homeowners association fees. In many cases, the bank is comfortable with housing costs eating up a third of your gross income, sometimes more. On a high salary, that number gets very big, very fast. What rarely gets discussed is what that actually feels like in real life. A third of gross income might turn into nearly half of your take-home pay after taxes. Add in retirement savings, childcare, transportation, food, and everything else that makes life work, and suddenly the margin for error disappears. But again, that's not the bank's concern. If the payment clears and defaults stay statistically low, the system is doing what it's designed to do. Another factor banks look at is your credit history, but not in the way most people think. A high credit score doesn't mean you're good with money. It means you're good at paying debts on time. That's an important distinction. Someone who consistently carries large balances but never misses a payment can look safer to a bank than someone who lives simply and avoids debt altogether. This is why people who already have student loans, car payments, and credit card balances can still qualify for massive mortgages. As long as those debts are being serviced reliably, they are treated as manageable. The system assumes you will continue juggling them. It does not assume you will want breathing room or financial peace. Income stability also plays a role, but it's often assessed more crudely than people expect. A salaried job with a steady paycheck is favored, even if it's stressful or limits future growth. Variable income, like bonuses, commissions, or self-employment earnings, maybe discounted or averaged. The irony is that some of the most financially savvy people get approved for less because their income doesn't fit neatly into the model. Then there's the interest rate environment, which quietly shapes everything. When rates are low, monthly payments look deceptively affordable. Banks can approve larger loans without changing their formulas, simply because the payment math works out. When rates rise, the same buyers suddenly qualify for much less, even if nothing about their lives has changed. What almost never enters the calculation is how long you plan to stay in the home, whether you want to change careers, start a business, have more children, or take time off work. Banks don't model your future goals. They model your current capacity to pay. If your life changes later, that's your problem, not theirs. This is where many high-income homeowners quietly get into trouble. They buy at the top of what they're approved for, assuming approval equals safety. At first, everything works. Payments get made, the house looks great. On the outside, it looks like success. But inside, the budget becomes tight. Savings slow down. Flexibility disappears. Every unexpected expense feels heavier than it should. Over time, this pressure accumulates. Raises don't feel like progress because they're already spoken for. Job dissatisfaction grows because walking away feels impossible. The house becomes an anchor instead of a foundation. None of this shows up in default statistics, so the system doesn't see a problem. From the bank's perspective, the loan is performing perfectly. It's important to understand that banks don't need you to thrive. They need you to pay. Those are very different thresholds. A loan can be technically successful while slowly eroding your quality of life. And because this erosion is quiet and gradual, many people blame themselves rather than the structure they stepped into. This is also why advice like, buy as much house as you can afford, is so dangerous. Afford according to whom? According to a spreadsheet designed to minimize lender risk, or according to a life you actually want to live? Those are not the same thing, even though they're often presented as if they are. The most financially resilient homeowners don't buy at their maximum approval. They leave room. Room for bad years, room for opportunity, room to say no to things they don't want to do. That margin doesn't look impressive on paper, but it feels incredible over time. Understanding how banks decide what you qualify for isn't about gaming the system. It's about seeing the system clearly enough not to confuse its incentives with your own. The bank's math answers a narrow question. Can you carry this debt under average conditions? It does not answer the more important one. Will this house support the life you want to build? Once you see that distinction, the approval number loses its authority. It becomes just one data point, not a recommendation. And that shift in perspective is often the difference between owning a house that adds stability to your life and owning one that quietly drains it.